Hello, and welcome to the launch of the State of European Tech 2020, the virtual edition. My name is Tom Weymire, partner at Atomico.
And I'm Sarah Gamori, Senior Associate at Atomico, and we're joining you live from the Thomson Reuters studio in London.
Now, usually, of course, we'd be sharing the findings of this report on stage at Slush, the annual tech gathering in Helsinki. But like so much in 2020, our plans changed due to the ongoing pandemic.
Over the next few hours, we'll be hearing from many of the biggest names in European tech as we talk about this extraordinary year, the lessons learned, and the way forward. There are unicorns aplenty, a newly minted decacorn, and we'll even nip to Paris for a sit-down with the French President Emmanuel Macron.
The one thing we all knew going into this year's edition is that COVID-19 affected every business in some way or other. And whether it sent revenues plummeting or skyrocketing, all companies had to find their own ways to adapt, survive, or thrive. This is why this year's version of the State of European Tech is such an important barometer. Thanks to all of our partners and the thousands of you that responded to our survey from all over Europe, this is the biggest report of its kind and allows us to gain unparalleled insight into what has happened and where we find ourselves now as we come to the end of this turbulent year. So what did we learn?
European tech came into 2020 on a roll. We had seen a decade of continuous growth, and although there were still some questions about the future, it had created a solid foundation of belief in European tech, not just from our own ecosystem, but globally. Then, COVID-19 hits, of course, bringing volatility and uncertainty, as well as a new set of questions. How would founders and investors adapt? Would investment dry up? It won't come as a surprise that many founders had a tough year. Mental well-being was a challenge they most frequently highlighted. This was closely followed by the pressure of finding ways to motivate their teams. It's hard to say whether the fundraising bar was objectively higher this year, but a majority of founders felt it was. The impact was not felt equally by all sectors. For many health tech companies, the pandemic has been a tailwind, and they raised record amounts this year. European SaaS is also firing on all cylinders, but investment slowed down for real estate, transportation, and travel. That being said, we've seen so many examples of companies defying the odds and raising huge rounds despite a collapse in demand. Voi, Tier Mobility, Get Your Guide, just to name a few, and we will be joined later by Naren, founder of Omio.
So net-net, European tech has benefited from the shift to digital brought about by COVID-19. We're on track for another record year of investment, and earlier in the year this didn't look remotely possible. But since the summer, investment activity has been strong and sustained, including what was an all-time record month in September. And this was driven by a record number of rounds above $100 million. These days, such rounds no longer raise eyebrows, but we shouldn't forget how far we've come. Just 5 years ago, a keynote panel at Slush discussed how to raise above $10 million in Europe. And Sebastian from Klarna, who's joining us later, was actually on that panel. This year, Klarna raised $650 million in a single round. It's incredible to see how times have changed. And the scale and velocity of the ecosystem is transformed too. More recent cohorts of European startups are raising faster and more aggressively. And as more capital has flooded in, valuations are soaring across all stages. This is partly driven by simple supply and demand. There's more capital chasing stronger companies, and we have a record number of investors active in all stages of European tech, with record dry powder to put to work and stronger LP appetite than ever before. And this should be no surprise. LPs follow performance, and European VC is demonstrating it's an outperforming asset class. International investment has also not dried up, as some feared that it might. US investor participation reached record levels again this year, and it's not hard to see why they're coming. We've seen no slowdown in the number of new unicorns. We've had 17 this year already, and we're still counting. And so what we're seeing in 2020 is the result of an ecosystem underpinned by a flywheel that is now spinning faster than ever and is systematically recycling capital and talent at scale to start and build better companies, attract world-class investors, and to deliver extraordinary outcomes. But this flywheel can spin even faster. So let's take a look at how.
First of all, let's focus on builders. More and more people are looking to work in tech. We've seen a sharp increase of tech job searches all over Europe. But what's maybe more telling is that the growing depth of the operating talent pool has made it an attractive place for investors with a talent-first mindset. Programs like Entrepreneur First or Antler are removing friction to smooth the transition into entrepreneurship and to make it the default path for our most talented people. There is no doubt that we're seeing systematic recycling of talents. Over 2,300 founders have emerged from just 24 of our most successful European scale-ups to build the next generation of companies. But as we recycle talents, we need to be mindful of the makeup of the next generation of founders too. If we look at the senior leadership of startups and scale-ups today, it is disproportionately male and white. The current inequities of our ecosystem are excluding talent and ideas and making it harder for underrepresented founders to succeed. They found it even more challenging to raise capital this year than their peers. In the wake of the Black Lives Matter movement, data is finally emerging on the amount of capital going to Black founders. And it is grim. Only 0.2% in a whole decade of investment into UK tech companies. What about progress on capital raised by women founders? Well, there has been none since we began producing this report. Only by addressing this will we fuel our flywheel. And the rationale should be obvious. The more investors and founders are open to bold, new, different ideas, the more we will continue to build great companies. Especially since we've built an ecosystem that consistently funnels our best ideas to billion-dollar valuations. It's 1 in 100 shots on both sides of the Atlantic. And we're seeing hundreds of companies do this now. The herd is not only growing in number, the companies themselves are getting bigger. This year, Klarna and UiPath became our first venture-backed tech companies to reach $10 billion valuation, while still being private. Spotify and Adyen grew to 50. 100 billion valuations are not aspirational, but inevitable. It's not just scale that has been transformed. The velocity of the ecosystem has accelerated too. Companies are reaching unicorn status faster than ever. First Kazoo, then Hopin broke the 15-year record held by Skype this year. And we're super excited to hear more on this from Johnny later. But levels of per capita investment vary widely across Europe, and this is both a challenge and an opportunity. We should be excited by the significant upside here.
So who are the investors betting on the European tech opportunity? Europe's LP base is becoming ever more diverse and sophisticated. Institutional investors like pension funds and sovereign wealth funds have increased their allocations to European VC threefold over the last 5 years. And consequently, the share of funds from government agencies is rapidly declining. It now accounts for less than 20% overall and is into the single digits in Europe's most mature markets. And talent recycling is also happening on the investor side. More and more investors are striking out on their own to build a whole new generation of funds in Europe. But if European VC is going to scale, it will need to fight for greater allocation from institutional LPs. Today, VC represents just 3% of total pension funds committed to private equity in Europe, even though European VC is offering stronger returns.
And the final piece of the flywheel, the extraordinary outcomes it can create. 2020 saw some big tech IPOs from Europe, Allegro at $19 billion, the Hut Group at 8, and although we had more tech IPOs than the US this year, we were completely overshadowed by the flood of huge listings like Snowflake on the other side of the pond. As our largest companies list on US exchanges or are acquired by non-European buyers, the question of value leakage from Europe is often posed. Overall, US listings and US M&A transactions accounted for 52% of the combined exit value of large venture-backed European tech companies. Across the full universe of public European tech companies, it's a more nuanced story. In fact, only 3% are listed on US exchanges, but they represent 11% of aggregate market cap. The likelihood that large European tech companies choose to list in the US is almost 5 times greater for those founded more recently. So, is the US the default destination for all? No, but is it a choice for a meaningful number of them? Yes. So the value leakage question is relevant. And also timely. Europe now has a pipeline of potential IPO candidates valued at over $150 billion. Some have signaled their intent to IPO next year. It's much less a question of whether they will list, but when, and whether they will do it in Europe. The companies that make it to real scale and go on to IPO are one thing, but it's not the only problem when it comes to European capital markets. Europe's real challenge is in creating a sufficiently deep and liquid market for companies of all scales. It's often said that European companies sell out earlier, but the data challenges that. US companies are in fact 50% more likely to exit, starting right from the early stages. Exits are not a bug, but rather a feature of a functioning market. And so, to create options for timely exits, we need more active tech buyers at every stage. There are 3 hopeful trends that we see. First, Europe's venture capital and private equity investors are working in ever closer union. Private equity-led buyouts have emerged as a viable path for venture-backed companies. This year, we've seen transactions such as Pipedrive and Idealista. Second, traditional companies have also started to make huge acquisitions of venture-backed businesses. Flash and Post and Charlotte Tilbury were 2 recent examples of billion-dollar acquisitions. And lastly, as publicly listed venture-backed companies like Just Eat and Kahoot scale further and look for growth, they will continue to acquire other tech companies.
But why do we care about it? And why should you? Well, first, even at a reduced rate, European startups are an unmatched engine of job growth. The speed at which startups added new jobs this year far outstripped the rest of the European economy, in spite of those COVID headwinds. And second, tech is critical to Europe's economic growth and future global competitiveness. We grew the value of our ecosystem 5x in just 5 years. And that means that today, each time we double from here on in, we'll be adding another $1 trillion of value. But we're still playing catch up following several lost decades when European tech was, frankly, in the wilderness. Today, we account for just 6% of public tech market cap, though we represent 24% of global GDP. We'd add trillions of dollars if we punched at our real weight. And that is the real prize that we're going after. Third, because a faster flywheel means more capital and more talent for purpose-driven companies. Founders, employees, VCs, and LPs all told us it is increasingly important for them to play their part and to start, build, and fund companies taking on the world's hardest problems. Take the climate crisis. In the last 5 years alone, over $11 billion has been invested into startups addressing climate action in Europe. And this can be further accelerated by the forthcoming €1 trillion investment under the EU's Green Deal. But more than anything, the flywheel matters too because it shapes our mindset. Cycles of success inspire belief, raise ambition levels, and build confidence. And these are vital ingredients when it comes to building extraordinary companies. But this is not about blind optimism either. As we've shown, we still have challenges that are holding us back. But it's in our hands now to write the next chapter. Thank you.
We're going to take a quick 5-minute break now, but don't go anywhere. We've got European unicorns, decacorns, and one very famous president still to come. So don't miss it.
Right, welcome back. And next up I'm going to be joined by the people and the organizations that help to make all of this possible. So let me quickly introduce them. Mitch Zuckley, Chairman and CEO of Orrick, Mika Huutonen, CEO of Slush, and finally, Erin Platts, Head of EMEA and President of the UK branch of Silicon Valley Bank. Right, we haven't got much time, so let's get straight into it, everyone. It's so great to have you with us. Thanks for joining me today. So, as we've just heard, 2020 has been this year of countless challenges, pivots for so many, but also a time of new momentum for European tech. And Mika, I wanted to start with you first. You spend so much time in the early stage founder community. What did you hear from early stage startups this year about surviving in what's been such a turbulent time? And what did you think it showed about the ecosystem's resilience?
Yeah, I think 2020 was definitely a story about product and business model pivots. I think when we discussed with founders in April, only 41% kind of kept their focus totally unchanged, which meant that out of those who had actually pivoted, far more had expanded to totally new activities instead of cutting the existing ones. And I think this really speaks of the agility of the startups and the optimistic manner in which they use that agility. But I think if we look back also 10 years from now, the argument may have been that European founders are a bit risk averse and maybe ready to jump to the comfort of just steady job on the first side of the trouble. And I think today the story couldn't be more different. European companies are built increasingly by people who have done it before or who are actually founders by nature. And that's just really good thing also for the thing you mentioned about this flywheel, making that positive momentum pick up. And I think deep down, that's the story behind Europe's resilience.
Thanks, Mika. And you're right, it's been unbelievably impressive just to see the way in which companies have responded and had to adapt. And you know, I think you talk about the growing maturity of the ecosystem. And I want to switch maybe from the early stage part of the spectrum to, you know, to kind of later on in that startup journey. And let's talk a little bit about exits, you know, right at the other end. And as we said, you know, Europe's been overshadowed by some giant tech IPOs that we've seen in the US. And then we've also had this whole phenomenon of SPACs. Mitch, you've got such a great view sort of spanning both sides of the pond. How did you see that play out? Mitch, if I ask you to perhaps comment on that one first.
But I cannot hear Tom, I'm afraid.
Okay, Erin, maybe I'll come to you then.
About your experience in seeing the rise of exits and SPACs across the US and European landscape.
In the States by mega IPOs, companies like Snowflake and Palantir and Asana and Lemonade. But the real interesting item here in the States, I think, has been the rise of SPACs. And we are looking with incredible excitement at something like Arrival choosing to do a listing in the United States through a SPAC. And so we're excited about the number and prospects of unicorns choosing the SPAC route in the United States. There's intense interest in SPACs. We think that SPACs will continue as a great trend into 2021. And all of us here in the States are excited to see whether or not European unicorns are going to follow the Arrival path and use the SPAC route more. And I apologize, Tom, that I couldn't hear you at all. So thank you for repeating the question.
No, that was wonderful teamwork. Erin, thank you for stepping in there. That worked smoothly. And yeah, I think we have this sort of theme coming through of the ecosystem maturing. And you know, another way that I think that's sort of been interesting to observe has been the rise of alternative funding avenues for founders. And one that I think, you know, stepped into the spotlight, if you like, this year was venture debt. And it's an area that we've explored in a huge amount in the report. Erin, you obviously have great visibility into what's happening around that. It would be wonderful to hear, how you've seen this evolve, this year in particular.
Yeah, of course. No, it's been, as your introduction alluded to, it's been great to see the depth of sophistication of capital available to founders across the board on the equity side, and that's absolutely been mirrored. I would say in two areas, we've seen the attitude towards founder liquidity, change in real time, and then the rise of debt. And I think it's natural as the whole ecosystem has matured and scaled that the types of options available to founders has increased and become increasingly sophisticated. So whether that be venture debt, acquisition financing, creative ways to finance working capital or customer acquisition finance, these tools are used across the board in our US portfolio. And I would say the comfort, understanding, and demand has really evolved in the last 12 to 24 months. And I see that increasing. What I would say as a provider of debt is it has a time and place. It should not be used to replace equity. It should be used to supplement equity. It should be used thoughtfully. We've seen a few great examples of companies like SNCC and Trustpilot and Day use it as a tool to complement their capital stack. And I think that's what's exciting, is it gives founders optionality and ways to scale their companies even more quickly without having to rely solely on the equity market.
I think that's exactly right. As you say, it's about creating options for founders, and whether that is going down the equity route with VC, or whether that is taking debt as alongside that, or whether in some cases even which I think is something that we actually potentially see as a somewhat unique thing in Europe, of companies going onto the public markets at smaller cap and using that as as an avenue by which to raise capital. I think it all speaks to the ways in which we're seeing the ecosystem mature, and I think that word that you used, Erin, sophistication, is an interesting one, because one of the trends that we highlighted again this year has been the increased investment into the European tech ecosystem from the US. We've seen record levels of investment from US investors, and I think it's interesting to reflect from here in Europe, how do we see that this is changing market dynamics? Mitch, maybe you can take that one first, if you can hear me now.
I can hear you beautifully, Tom.
Wonderful.
So I would say that I would expect the strong US interest in investment in Europe to only continue. As you pointed out in your opening remarks, Tom, European VC is an outperforming asset class. And investors here in Silicon Valley and the rest of the states look to the European ecosystem as very healthy. When they see, Seed Camp being such a robust source of early capital, and they see companies like Hopin and Revolut and 17 new unicorns being produced this year, there is very strong interest in this economy. And there's a sense that valuations are more reasonable and less frothy than they are in the States. So I think you're only going to see continued strong US investment and investment in Europe. One of the things that we're seeing here in the Valley is increasing numbers of US investors asking us questions about, boy, have you ever done a deal in Romania? Or what are the impacts of Brexit? Or tell me more about the privacy regimes in Europe, and should we be concerned about X, Y, or Z in a particular jurisdiction? All of that augurs for a very strong, sustained investment in Europe over time.
And Mika, Slush has always had strong links into the US. I remember for several years you ran the Nerdbird, shuttling people over in a flight that you chartered yourselves. What have you been seeing around this trend?
Well, as you mentioned, we had the Nerdbird just as a way to get the US investors to the Europe and to the Finland and to the Nordics. And now increasingly, we dream about having these top tier venture funds coming to the Europe 5 years ago, and now we're doing things with them, and they're also really willing to work with us. And I think that's something we couldn't even imagine 5 years ago, and that's really exciting to see also for the European companies.
And Erin, the clue's in the name, right? Silicon Valley Bank. You have a great window into this trend. It would be wonderful to get some reflections from you too.
Yeah, I mean, the phone is ringing, right, from our US investors really looking to deploy capital to get to know what's happening on the ground here. And as Mitch said, the reason why is we are creating and scaling global category leaders across the UK and Europe. And it's not just one subsector, it's not just one country, it's across the board. So I totally agree with the other comments. I don't see a slowdown. I think we're going to continue to see more and more demand. And a few, anecdotes. Speaking to some of our U.S. venture funds, a number of them have formally increased allocation, right, in terms of their expectations to deploy capital outside of the U.S. And so that commitment to their LPs just shows the programmatic shift that I think we're seeing in terms of U.S. venture funds. And the other notable change, I remember 5-10 years ago, you'd have a fund fly in, take a look at what was going on, and then maybe there's one partner that was in charge of European coverage. And now, again, I would say it's really a shift in partnership appetite. And I think we'll see more and more funds putting permanent people on the ground, a la Sequoia and others.
Thanks, Erin. And let's switch topics somewhat, and let's talk about D&I. I think this was a part of the report where it was less obvious to see momentum. Are any of you seeing progress on this, and what's your view? What's holding us back, if anything? Mika, I don't know if you let's go to you first. What are you seeing?
I think there has been good progress on some fronts on this, but as well we found that diversity and inclusion was left out of the discussions due to the COVID, especially in companies where it's not a core part of the strategy. And when companies are in a wartime, including Slush, it's way too easy to slip the focus around this important topic. And I think the state of the European tech data supports this in a way that, let's say, not one deal was over $50 million was raised in 2020 by all women founding team. And maybe one way to create significant progress on this, and possibly very efficient way, is to create strong and diverse angel investing networks that know each other in Europe.
And Mitch, what are you seeing? I know you're there on the ground over in the US, and where perhaps this has been part of the conversation for a longer period of time. Do you have any reflections on this?
I would say it has been a part of the conversation here in Silicon Valley for a longer period of time. That said, our progress hasn't been overwhelmingly impressive. That there has been recently a group of new organizations like Operators Collective, an incredibly strong group of women entrepreneurs who invest in one another and support one another, that are lovely green shoots. And we've seen commitments from folks like K4 Capital and Bronze Investments for a long period of time to focus on other forms of diversity. What I think I'm most worried about now is that 2020 has put an unbelievable burden on folks who are caregivers. We're all working from home and living at work. And a recent McKinsey report suggested that 40% of professional women are thinking of stepping back right now during COVID because of the unbelievable burdens placed upon them as caregivers, in addition to balancing work. And that's an issue that we're going to have to wrestle with all around the globe if we're going to retain the talent that we're trying so hard to get into the tech ecosystem.
I think you're absolutely right in that it requires laser focus and an ongoing sustained commitment if we really want to see progress on this. So we have a couple of minutes left. One final quick question for you all. And I want you to do this in no more than 3 words. So what's one trend that you'll be keeping an eye on in 2021? So Erin, I'm going to start with you, and then Mitch, and then Mika.
I'm going to answer the question in a slightly different way. The one word that springs out for me is momentum. I mean, it feels like there's no question that European tech has arrived, and I really look forward to seeing what this group can do next.
And Mitch?
I'll answer cross-border SPACs. Very interested to see whether the SPAC trend continues and how much these outstanding European unicorns are using that as a mechanism for liquidity.
Great. Mika, finally.
European science-based companies.
Okay, so momentum, SPACs, science-based companies. To be honest, I wouldn't be surprised if we saw all three of those in the same company. It's going to be an interesting year next year for sure. So thank you all so much for joining us today. And we're going to now go into another short break, but please don't go anywhere. We have a wonderful panel coming right up. Welcome back, and we're turning now to TechCrunch Europe correspondent Steve O'Hear, who's speaking with the founders of Klarna and Omio, two of Europe's most respected companies. Over to you, Steve.
Thanks, Tom. Okay, so we don't have a tremendous amount of time, and I think it's been a pretty momentous year for good and bad reasons. So I want to get through quite a lot if we can. Let's just start by setting the scene, because obviously you are running two very different companies in completely different spaces, right? E-commerce, payments, neobanking with Klarna, and travel with Omio. And obviously, like, one company has, at least on paper, done very, very well during this terrible 9 months. And another company has suffered quite badly as global travel has been so disrupted. But that's my words. Let's start with you guys. Maybe in one or two sentences, you could sum up what the last 9 months has been like, just to set a bit of context. So start with you, Sebastian.
Yeah, well, I think that, like, obviously on a kind of global level, whatever you want to call it, on a human level, like, it's a big tragedy, and I also have some friends that have been personally affected by it, right? So that's, I think, is first and foremost added. And obviously the initial weeks especially were a lot about worrying, like, what was actually going to happen and how severe was it going to be, and all these things that I think went through people's minds. But since then, for Klarna, it's been obviously much more about coping with the growth and the demand that the digital acceleration has meant for somebody like us. So a lot of focus on making sure that we're properly set up, and then and also to some degree, obviously, that we take the opportunity of this in the sense of making sure that we offer our services and expand our services and so forth accordingly. So that's been it in the 9 months summarized.
And Naren?
Yeah, I think probably the opposite end of a roller coaster for us in terms of revenues dropping 98% in April, one furlough with the teams, then a restructuring, then a fundraise, then a boom in the summer, and then back to second wave and back to a second furlough. So as much of a roller coaster as you can ever imagine, and then multiply that 10x, and that's what we've been through.
And if we stay with Omio for a minute, like, can you remember the moment you thought, like, oh, this is serious?
Yeah, probably yes. I think, again, it took a couple of weeks to hit you really, really hard when you're starting to. So you can, the moment from when the lockdowns come in, the first wave I'm talking about, we started traffic dropping or usage dropping late February, which was started in Italy and then started spreading across the rest of Europe. At that time, it was clear for us that it would be across all of Europe. So by then, until call it maybe mid-March, second, third week of March, we were mainly running so fast to contain the damage, try and understand what's happening. We had tens of millions of cash going the opposite direction because of cancellations, refunds that we needed to protect the balance sheet. So there wasn't a moment of, oh shit, this is going to be serious. It was just running to contain what the issue would be. And then only when we started, out of that, okay, the business is protected now. Now we need to think through how long this is going to take, is when it really hits you in terms of, okay, this is going to be a sustained damage to the industry and sector. We will come out of it stronger, but it was very much no light at the end of the tunnel moment back then in call it March, April versus now.
And obviously, conversely, probably we didn't know it at the time, but e-commerce, has gone kind of gangbusters, right? So, Sebastian, what was, where were you when you thought this is definitely changing the market dramatically, practically overnight?
I think for us also, like, we're almost 3,500 people now, and so what I also felt was important, like what we started seeing first was we started seeing a shift in volume. So because we also own Support, which is a direct debit payment method, which actually supports remittances and other type of services as well. We started, they also support, for example, trading platforms. So we started seeing massive increase in money being flowed into stock market trading, into remittances. And so our volumes were actually growing, but the e-commerce, especially within fashion, was kind of going slightly down, but not massively. And at that point in time, there was a lot of discussions, obviously, because I don't know if people haven't, this hasn't really been reported widely, but in Wuhan, e-commerce was actually down about 70%. And the reason for that is that the logistics in Wuhan were dependent on motorcycle delivery people who were coming from outside of the city and driving into the city with different packages. And so as the lockdown happened in Wuhan, that was just cut off. And as a consequence, the only e-commerce that was actually functioning in Wuhan during the lockdown was groceries. And so when we understood this, we understood that obviously this could have a very material impact on physical goods e-commerce in general as well. And there was a lot of discussions to what degree. There were some of our customers that were considering closing warehouses because there were discussions about risks of spreading disease within the warehouses and so forth. So there was a couple of weeks where it was very still unclear to what degree it would impact physical goods retail beyond the groceries that obviously had to function due to the essence and pharmacy e-commerce. But then as it started turning out that there were safe ways in which warehouses could continue function and the lockdown went in that direction, then you started seeing instead the dramatic increases connected to people stopping spending in retail stores and start spending more online. And then there's been a couple of small other shifts that's been interesting. So for example, return rates overall in fashion has gone down quite dramatically because people shop a different type of items than they used to do. So there's been a couple of other differences as well, but those were the kind of things. So that it took a couple of weeks to kind of understand what that was going on and that this was actually going to be for us, something that was going to accelerate our business. And then secondly, I think what was important because we also had some people calling us and oh my God, everything is changing in the world. You have to change strategy, you have to change this and so forth. And I was pushing back quite hard and saying, look, I think the best thing we need to do now is focus on the business, focus on what we do and let time pass a little bit and see how things play out before we kind of make too big of changes immediately, because you don't want to kind of.
When you say change strategy, can you give us some sort of insight into what those strategy changes that were being suggested? Because that's quite interesting.
Well, for example, since we're in an investing, we are obviously investing heavily in new markets currently in kind of expansion and so forth. There were some people calling us and suggesting that let's change that strategy. Now it's all going to be about survival, about cutting your costs and so forth. And I even saw some of our competitors actually furloughing people, not even furloughing, but actually closing down and letting people go. And at that point in time, we said, look, that is a very premature decision. We have to wait and see a little bit how things go. So I think it's important when you go through a crisis to kind of have a steady course, if you say what I mean, and be fairly obviously that shouldn't mean that you are naive about the consequences. Mm-hmm. And depending on company and where you are, different actions might be appropriate. But in our case, for us specifically, it was also important to not overreact, but kind of, think about this and be careful, because such actions does have consequences, especially for a bank, where, a lot of it is trust and the trust of us as a financial institution and the fact that we're dealing with people's money and so forth. So it's even more important maybe in one way than in, a classical tech company.
Yeah, no, of course. So you had to hold your nerve, essentially. And now with Omio, presumably burn rate and the fact that nobody knew when travel was going to come back, if it was going to come back, to what degree. And I was reading up today about, there's been some sort of behavioral changes in the way people are traveling as well. So tell us what you had to do initially, in a sense to buy yourself time to work out what the heck was going on. And also, I know that you also managed to raise a significant funding round right in the middle of all of this, right?
Yeah, I think, to start with, we, as soon as this hit, we moved to a very clear communications framework where, we knew travel is going to be impacted quite heavily as an industry, and we need to engage more heavily than you would in a normal situation with your teams and also with your customers, etc. So we moved to a framework where we have, three pillars. One is transparency, frequency, and concreteness. Communication. So we get out in front of the company as frequently as possible, sometimes 2 times a week. sharing what we observe, what we notice from within our own data, from outside the industry, contacts we have, etc. Concreteness, because a lot of companies in the travel industry laid off people. It started with Expedia, Booking.com, Airbnb did it very publicly, etc. So we needed to get out to get rid of the fear in terms of, hey, look, we're stable, we're going to come out on the other side. We have a strong balance sheet. Now it is going to be tough. It's not going to be fun, but we're going to come out stronger. And then the last one is around transparency. We shared as much as we could without creating any confusion. So that framework helped us and still helps us. We've continued that framework through the entire process. So the first step was really stabilize the balance sheet, because we have never actually seen this where cash moves the opposite direction. We generally have negative working capital. We collect cash and then pay back suppliers a few weeks later, and when cash starts moving the opposite direction, you don't really know how to react. So the first thing is to stabilize the balance sheet. Once we did that, the second thing is we created a very clear strategy into almost thesis driven what comes back. And we focused on 3 areas, which is content being critical. People want to know where lockdowns are, where they're going. And we started investing all the people we have around developing that content, because where can I find, do I need to quarantine? Can I cross the border? Et cetera, et cetera. So as a travel company, we wanted to empower customers to do that. So we created products that launched. It's called Open Travel Index. It's still live, that we update on a daily basis. The second thing is a thesis that, ground transport as an industry will come out a lot stronger than airline. So invested quite heavily in ground. And this was happening already with, the whole environmental friendliness, flight shame, etc. But, with COVID and the risks of airline travel, it really accelerated ground. So in like, some of the peak months during the summer, we were back up to 50-60% of pre-COVID levels with zero marketing, just organic traffic coming back on ground transport. So we invested quite heavily into that. And then the third one is understanding shifts on the consumer behavior and how we'll cater to, and the clear shift we saw was, a shift out of kiosk to apps. Our share of app usage went up drastically. Days to departure came down drastically. People who would plan a long time in advance started booking more last minute. So we started creating new products that cater to that. Flexibility came in very heavily. So more people would buy insurance, more flexible transport than, set prices, cheapest prices, etc. So evolved the product. So basically went after very clear thesis on, and this was not even when things came back in the summer. I'm talking about June, July, August. This is, already in April, we mapped out saying, if it comes back, this is how we would come back. We started investing in those areas specifically. And then, thankfully we got the fundraise done that gives us, much stronger balance sheet in terms of we're going to be here and we're going to see the light at the end of the tunnel. And basically we're continuing on this thesis right now.
And when you did the 100 million round, like, what was the sentiment with the, with the VCs?
It was one of the hardest fundraisers to do, because travel is not an asset class you would touch. But again, we're not the only one, right? Airbnb did it very early. I think the 2 things that helped us is our existing investors were the first to step in and say, we will make sure that you come out on the other side. So almost half the round was the existing investors putting in that created an easier pitch to the outside market. That we could go out and say, look, we're going to come out stronger, etc. And there are a lot of investors that know that travel is eternal, that have gone through cycles, 9/11, when the attack happened, all airports were shut down for weeks, and then, it came back booming. And if you look at the curve of travel industry, it's only been growing at like some astronomical pace over the last 2 decades or so, and it's not going to slow down. So it's only a matter of time. And then do you want to invest in this asset class? So the thing we did is we didn't price it, because that was the hardest to do. We mainly made it a convertible note. It was hard in that we still got a lot more no's than a normal fundraise process. But it is clear that when your insiders back you, and then you can use that story to get external capital, you're able to get a round done. I think without that, it would have been harder.
That's fascinating. Sebastian, obviously e-commerce is, has accelerated. Everyone's shopping online more, changing their behavior, like habits around how they shop, and that's that's been evident across anybody in the e-commerce space. But I'm wondering, like, are you worried that next year, the draft's going to even out a bit more, or do you think the new habits are here to stay?
No, I think it's an interesting question, but I just want to quickly comment also on Nareen said. I think two things that are interesting is like one is that obviously the thing that people don't always think about is also that Klarna, as we are suppliers, and not only to Nareen, but to a lot of other travel companies out there and ticketing companies and so forth, actually part of our focus during the COVID is also that like we are standing a financial risk against any of our customers, right? So part of it was also that created a challenge for us because in those situations we needed to assess each of those customers. We have airlines as well, like what are those airlines going to survive or not? What are the risks for us if they don't survive? And so a big challenge for us was also all the hard work to kind of make sure that we understood the underlying risks that we had with our customers, with the merchants in this case, or the partners that we have. And then, and it's also a very difficult discussion because, you obviously understand that these companies are under heavy stress. And at the same point of time, you have a responsibility to your shareholders and to our regulators that we kind of engage in conversations with these companies regarding their situation. And try to see whether we need to take some mitigating actions or do something and so forth. So, and then what you want to be careful in those conversations as well is that you want to send a signal to anyone in that industry that you're a long-term partner that believe in them. And at the same point of time, you need to take, you need to do what you are responsible, what is responsible to do in each one of those. So, and obviously every company has different circumstances and different prerequisites. So it's different per company, but that was one of the most difficult parts for Klarna actually, was in relationship to all the great companies we work with, airlines, travel companies, ticketing companies. How did we deal with the situation and the conversations in a way that they felt that we were, supporting and backing them a long-term partner, but at the same time did what we, are required to do from regulatory and versus our shareholders, right? So that was it was just a reflection I had, but I also thought about it when Nareen said it. Like the other part of that though is that when I hear all the actions that they took, I mean, what people tend to forget is that like I don't think it's the Airbnb or Neo of the world that they will come through this stronger. They will probably gain market share, and they will come out of this successful, even though they may have a tough year. It's the companies that were in that industry that were already kind of being disrupted by these new entrants. They are the ones that obviously we have accelerated the demise of those companies. And I think that's the big shift, right? So it's more those that was also in our assessment when we looked at it. Like we weren't worried about companies like Omea. We were worried about more legacy companies with more legacy infrastructure that were more acting that. Those were the ones that we saw as the one being the most vulnerable in the crisis, and some of them have not survived either. So I think that's something that I'm quite impressed when I hear Nadine speak about all the actions they took on such short period of time and stuff like that. But that again speaks to how you survive a crisis, that agility, the decision making, and so forth, and the healthiness of those organizations is what really makes, what sorts out a company that will survive or a company that will challenge. It's not entirely true always. Sometimes the macro elements are just too overwhelming and there's nothing you can do about it, right? So obviously it's a mix, but I do think there is a strong correlation. And to answer your question, look, I think that from our side, we are definitely seeing that people are not going back to the old ways, and that's just that's I think is very clear. So yes, are people going to go back and start shopping in stores again? Of course they will. Of course they will start traveling again. But this has the lasting impact. This has taught us so much about how we work, about how we travel, about what we appreciate in life, how we spend our money. And I think people don't learn by hearing things or watching movies, or even if it's the greatest TED 15 minutes or whatever. I don't think they change our lives that much, but an experience, something that we go through, are things that really impact us as individuals. And I think this is one that it's like maybe the most, in that sense, rare event that's ever happened in humanity, that we've jointly gone through an experience like this. I don't know, maybe you have to go back to the world wars of finding very extreme events that have impacted so many people. So obviously that's very big difference still as an event, but you get my point. Like it's really affected everyone in the world jointly, and we've had a different experience. So So I think that will impact, and e-commerce for sure is not going to go back. Like people will continue shopping much more online.
Absolutely, and I think it's going to be interesting seeing, to your point about legacy businesses and how that fallout, where it lands next year. I think we're basically out of time, but that was really interesting. I could have heard lots more on that. It's been a very, very interesting and emotional year. Thanks, both of you.
Thank you so much.
Thank you.
Right, and next up we're going to go back to the earlier stages and explore the question of what happens when you're just starting to get traction and then the ground suddenly shifts. Atomico partner Irina Haivas speaks to the founders of 2 Series A companies who experienced just that. Irina, over to you.
Thank you and welcome to this exciting panel. 2020 was a challenging year for the earliest stages of European tech. While the world scrambled to find better ways of working remotely, consumer services connecting the offline world to the online consumers ground to a halt. 2 such examples here in Europe are Beauty Stack founder Sharmadeen and Catalog founder Tarek. We're excited to hear from them about their lessons learned in 2020 and what they feel the future holds for consumer and enterprise tech in Europe. Sharmadeen, would you like to do a quick intro?
Hey everybody, my name's Sharmadeen Reid. I'm the founder of Beauty Stack. Beauty Stack is a visual booking platform for beauty and wellness services. So if you want to find someone who can braid your hair like mine, you would click a picture on it and be able to book the exact image with the exact person who did it direct from the picture.
Thank you. And Tarek?
Yeah, hi, I'm the founder and CEO of Catalog. We're based in London. We're a platform to help teams and businesses bring together people, teams, and projects and their data across all of their siloed tooling into a single platform.
Sharmadeen, let's start with you. Tell us about how you experienced the pandemic and how did you pivot the business when beauty professionals couldn't meet their clients anymore?
So the pandemic affected us very immediately and very adversely. When the first lockdown was announced on March the 23rd, our entire app essentially went from, growing metrics with our early user group all the way down to 0. But we kicked in pretty quickly, actually. I actually just checked the date because I wanted to look for my end of year roundup, but we turned around our first virtual event for our pros on March the 29th. So it happened really, really quickly. What we did was take a very successful beauty professional on our app. We hosted a masterclass for her, and she had 200 signups from all over the world learn how to paint nails with a flame nail design. And she made so much money. She actually made almost her entire month's salary from this one event that I thought, oh my goodness, she's never going to want to go back to the salon ever again. And I put in my investor update in the month of March, this could possibly be quite a big feature for us. At that point in time, no one knew how long the pandemic was going to last. Nobody knew how long beauty services would be out of business. But I had an intuitive feeling that this would be able to fulfill our original mission of economically empowering women, because we could go from having a one-to-one transaction to a one-to-many transaction. The other issue with the pandemic for us is that we were actually like pre-open access launch. So we weren't, we were going to launch this year and it just wasn't a good time. So yeah, I definitely felt that we were affected by being in the beauty industry with our users, but we were also affected as a startup that we left it long to launch and we found it difficult to launch in the middle of a pandemic.
So Tarek, what was it like for you to be a very early stage pre-official launch business in the middle of the pandemic? How did that impact you?
We had raised a seed round like around 4 months before the pandemic began. And so we had got some momentum going already to raise the A during the pandemic. We did benefit with some tailwind with around 1,500 businesses asking for access to the platform. Many had just shifted to remote work, so they were looking for a way to bring all of their tools, processes, and people together in a sensible way. Negatively, it did affect hiring with some people that were supposed to join didn't end up joining. Many people were on the fence about joining a company in that state of the world. There were finalized hires that had to roll back their decisions and go back to their safe jobs in big tech. So things are more or less back to normal now on the hiring front, but negatively impacted on the hiring front especially. But otherwise, business was great.
And how is it actually, for a question for both of you, how have you built your business in 2020? What was it like to not just hire, but also develop talent, keep teams together, and even fundraise in a virtual world?
The team in general, I felt that we were a very small, tight team and we kept regular communication. And I was quite surprised. I guess we have quite a lot of introverts on our team, but they all really enjoyed working from home and we just kept up a regular cadence of meetings. We didn't do anything, we didn't do Zoom quizzes and things like that. We were just really checking in on everybody's mental health and ensuring that there was space to talk, particularly with all of the issues around Black Lives Matter this year, because 40% of my team are of color. Sorry, what were all your questions? You asked for 3 points. You said team.
To develop talent, to keep teams together, to fundraise virtually, but also more generally, just building and running your business in 2020.
So they're all really different things. So with the team, I felt that I had to give really clear direction and structure. I had to keep really strong routine with them and I had to check in with them on a mental health basis. With my customers, I felt that Beauty Stack did an incredible job and I'm very proud of being there for our users in a way that wasn't just about like, how can we extract value from them? I really thought, how can we give value back and show them that we are a support for them? You've got to remember that almost all my users actually are small businesses or freelancers or individuals. They don't have a boss who can do a rousing speech on a Monday morning and get everyone like pumped up for the week. So we acted as that surrogate kind of manager and we did a lot of regular Zoom calls. We provided resource and we actually started doing classes on business to help them think about how they could grow their business during a pandemic. And then in terms of fundraising, we raised quite a large seed round and incredibly grateful for that, given that how this year has gone. So it's not something that has been top of mind for me, apart from our future raise, which, our metrics have been affected by the pandemic. But in general, running the business has been quite interesting in so far. It's really stretched my personal development in testing my resilience, testing my ability to lead, testing how we act as a company when the chips are down, not when everybody's singing our praises and, constantly talking about us, and actually making us really dead sure, like, are we executing on the company vision in the best way? So you know, right now when we're sitting here talking, I'm so happy, so optimistic, so looking forward to 2021 and what we're going to launch and what we're going to do. But again, if you asked me a couple of months ago, I might not have felt that way. So it's been a very roller coaster year, as many people have said.
Thank you. That's amazing. How about you, Tarek?
Personally, I was very skeptical about hiring and operating a fully remote team at this stage of the company. There's something special about a bunch of people like sitting in a room, hashing things out over a whiteboard and debugging over somebody else's shoulder. But I've been pleasantly surprised with how well the team has adapted to this way of working. I don't see any downsides now, if I'm honest. We're already somewhat in a meta way built on top of ourselves, so we're built on top of Catalog. So teams typically have a lot of visibility into each other's initiatives, and we have like processes that help with weekly roundups, team meetings, casual calls, and things that keep the team together as much as possible. I also think this has made the startup journey a lot more accessible to a lot more people than before. This has enabled us to hire globally. I think one of the big things that we've ended up doing is go fully remote. So we will shortly now have about, I think, 13 nationalities in a team of 25 spread across New York, London, Vermont, Boston, Delhi, Bangalore, Brussels, Singapore, and we'll be hiring more soon. And so I think that's helped with, one, building an incredibly diverse team, but also round-the-clock operations, basically, people building at every point in time in a given 24-hour day. On fundraising, I think we were lucky in that most of the fundraising conversations and relationships like existed well before the pandemic, and we were able to get that going. A huge amount of the fundraising decision calculus is based on trust and connection, especially at this early stage of the company. Getting that over a Zoom call is definitely a lot harder. But I've seen loads of my friends raise rounds in this setting. It's definitely doable, but I think it's a much tougher ask from both the VC and the founders to be able to make that connection over a Zoom call.
Thank you. It's very true. Sharmadian, back to you. How have you approached planning and just building a roadmap when the outlook of next year is so uncertain?
That's a great question, but I think that if you're a founder, all planning is kind of uncertain, right? Because you have this big idea, hopefully that will change the world. You don't necessarily know if you're going to have the right people to make that idea real, the money you need, the technical capabilities, the talent. There are so many different factors that will affect whether your planning can become real or not. So I'm used to, let's call it daydreaming, planning. And I think that's part and parcel of what it is to run a startup. It's to know that you can possibly plan 3 months, 6 months. I've always had a 7 to 10 year plan for the company, but who knows what's going to happen. For me, we do a quarterly brain dump with the entire company. It's one of our principles that everyone can contribute ideas. And then I go through a week or two of processing. And I find that the brain dump process, just like Tarek said earlier, works so much better when you're in a small team in one room around a table, and things and ideas and innovation just comes from everywhere. So what we're doing this year is, now that lockdown's lifted, we're going to do a half day in the office. We're going to map out our 2021 in the way that we always have, which is breaking it down into quarters, thinking, does everything go back to our vision and mission and principles? And most importantly, looking at how the landscape in our industry has changed, particularly in beauty and social network, and thinking about how we can capitalize on those changes or actually lead those changes. One of the things that is a really, really key principle for Beauty Stack is that we are applying different types of principles to a booking. So, you know, we're taking social mechanics to booking, we're taking personalized recommendations to beauty booking, and we're taking social proof to booking, and all of these different things that have been in technology for a long time but haven't actually been applied to beauty booking. So I like to look at the entire landscape, think what's happening here, where do I think it's going, is it relevant for our vision, and do I think we have the best shot at it? And that's how I tend to plan. And I actually always need a week away of introverted thinking actually to you know, see the future for our business.
Thank you. Tarek, you're building a workplace infrastructure, and how do you view collaboration when people will be able to get back to the offices? And what do you think are the changes that are here to stay in terms of the way we work?
Great question. From what we're seeing, the change is structural. I don't think companies are going to go back to the old ways of working ever again. Even at the early stages, we're saying like a partial in-person setup is the optimal way forward. Companies will also like rely more on tools and processes to keep things humming. One interesting we've started to note is companies and industries that were previously just purely reliant on the Office suite alone, think like Outlook, SharePoint, and Office, are now looking outside of their comfort zone and adopting tools that they previously would not have to make collaboration remotely easier. And maybe the softer side of things, people and trust have always been the backbone of teams and businesses. I think moving forward, there will be more of that needed. But interestingly, it's the new behaviors that are popping up to support that. So how do you build trust when your entire team is across 3 different time zones? How do you build the team morale when you can't necessarily have everybody in the same room? So that's one thing that people are asking for in terms of how do we help, how can we help them do that? But from a broader business perspective, businesses will also need to start thinking about resilience, not just from a balance sheet and market point of view, but also from their teams and internal processes that will help them weather their next storm.
True. I think we are all starting to feel that. If we kind of like step back and think about the lessons learned from this year, and that's a question for both of you, what is it that you've learned that you'll take forward into the future years?
Well, every year I write a blog post of everything I ever got wrong that year. And I think that this one is going to be pretty juicy and pretty funny. So I do like to go through that process of self-reflection, but it's very hard to think, what did I get wrong because of things that were out of my control versus what did I get wrong because I just made poor decisions, you know, at the time. I think my biggest lesson of this year for my business is that everything that was on your roadmap, don't wait for a pandemic to force it. You know, there have been so many incredible features that have come out of the pandemic from a technology viewpoint, a consumer technology. So, for example, you know, QR codes, like QR codes have been in Asia for so long. And this is the first time that, you know, the UK has actually started adopting QR codes via the restaurant network. And I think that that's exciting. Like, why wait that long? And for us, with we just released a feature a few weeks ago of virtual event ticketing system. And like I said, it's always been on our roadmap, not virtual, but events in general. I had the kind of inkling in March that this could be a thing, but why wait? So yeah, my biggest lesson is don't let a pandemic force you to do things that you should have actually done a long time ago.
It's a good one. Tarek?
I think the biggest takeaway this year has been just how resilient people in general are to adversity. I think, and also just all of the norms that we thought were absolutely critical. We have to go to the office. We have to have in-person meetings. We can only do things over a meal. Teams won't have the same sense of belonging if they can't go out for drinks or they can't go out for a meal. Is just, these are things that have turned out not to be true, and people have still found ways around it. And we've got commutes off, we've got in-person contact off, and people have still found ways to continue living and working. And that resilience has shocked me a bit. And so just generally questioning the status quo even more than before is definitely a takeaway from me this year.
I also actually want to follow on with that, because you're completely right. And actually it's shown that flexible working for women, which has often been said, not just women, actually all parents, flexible working for parents is something that people have been like, oh, it's never going to work, it's never going to work. And now everybody's been able to do it. And I just think that this pandemic has opened up way more opportunities to people who wouldn't have considered a career in technology because of the perceived, I have to go to Shoreditch, I have to work really long hours that are in these certain blocks. I'm really excited about the open access for career opportunities of people who wouldn't have considered it before, which is, I know you mentioned it before, Tarek, but actually your statement there just made me think even more how exciting that is, because an issue for me has always been that I want to hire people and not feel that they're nervous about telling me that they want to start a family, or I don't want to ever feel that I couldn't hire somebody who was already a parent for fear of, them thinking that they can't achieve their highest potential at this company. And now the pandemic and the remote working has made people know that actually you can do your job just as well from anywhere. And it doesn't have to, it can be completely asynchronous, and it's okay.
That's a really nice note to end this conversation on. Thank you both very much for joining us, and handing back to Tom in the studio.
Welcome back, everyone, and thank you, Irina. It's been absolutely fascinating to hear these founder stories, and we're going to go over to another founder now, to Tarvit Hinrikus, founder of TransferWise, one of Europe's leading fintechs, and he's going to turn the table and talk to an esteemed panel of investors about the lessons that they've learned this year. Over to you, Tarvit.
Thanks, Tom. Happy to be here. And thanks, everyone, for joining. We have a set of very esteemed guests for an action-packed panel. So let's get started. It's 2020, and we were promised flying cars, and instead we got this tiny virus that locked us all at home and turns the world on its head in many unpredictable ways. I'll ask everyone to do a quick intro and maybe share quickly, what did you learn this year? And quickly for my own intro, I'm Tarvit. I'm co-founder and chairman of TransferWise. I've invested in about 100 companies as an angel. And my learning for the year is I have lots of hope for humankind. We are very quick to adopt. So over to Hero to start.
Thanks, Tarvit. Great to be here with all you guys. My name is Hiro Tamura. I'm a partner at Atomico. We are a venture capital fund based in London, founded by Nicholas Sundstrom, who is the founder of Skype, and which Tarvit and I crossed paths way back when in history. So it's great to see people like Tavid, really taking off and becoming, leader entrepreneurs of Europe, and that's great to see. The thing I learned this year was about family. Inevitably, with the conditions that we were in, I think all of us, we spent more time at home. And for me, that was really learning more about myself and learning more about my family. And I think I've come out of it, a better person. And that to me was a silver lining of what otherwise was a very challenging year for many people.
Thank you, Hero. Let's pass it over to Rob.
Well, thanks so much for having me. So I'm Robert, founder of Visionaries Club. We're a 100 million Berlin-based fund focusing on investments in the B2B space. The little difference to other VC funds is that we only have success for entrepreneurs as our investors, because we think it's the best value add that we can provide to startup companies. And I think my learning for 2020 was a wake-up call for the old economy. So I was incredibly excited to see entrepreneurship at its best at family businesses, where we haven't really seen it, in the last 50 years, and really moving incredibly fast to change things, to engage in new digital technologies. And that's why I hope COVID is the chief digital officer of digitization in B2B. And I think that's what we need in Europe, because it's the biggest enablement we can have for startups that sell their technologies.
Thanks, Rob. How about you, Andy?
Hi, all. Thanks for having me. I'm Andy Davis, investor on the Atomico Angel Program and co-founder of 10x10, the UK's group of Black founders and investors, and GP at 10x10 Fund, a fund investing in early stage, exceptional Black founders. What I've learned from 2020 is that we have an ecosystem of resilient founders and investors who are open to learning and adapting every single day. We've seen the Black Lives Matter movement arise again. And what that meant was the world had to ask itself questions, and we had to look at ourselves and see if we had the answers. And the investment community has shown that it does. Atomico leading the way with a D&I commitment to invest in more diverse founders and increase diversity of their team, as an example. And on the founder side, went from the massive obstacles of COVID at the beginning of the year to sitting it out, building business, and now thriving towards the end of the year. And we're seeing more activity and more progress with early stage founders than we've ever seen before.
Thank you, Andy. And lastly, Leila, please.
So I'm Leila Zenia. It's great to be here. I'm one of the founding partners at Kindred Capital. We're a London-based seed fund where we share the upside of the fund with every founder that we invest in. So we turn every founder into a partner in the firm. 2020 has been a fascinating year, and I'd say my insight is characterized by the kind of RAG status that we, alongside every other venture fund, did in March when the lockdown happened of our portfolio. So we sort of triaged and gave them sort of a red, amber, green status, and it was very much oriented around the sector that they were in and how impacted they would be by the virus, and to some extent where they were in the capital raising cycle. And I think now, sort of 8 or 9 months forward, we can look back and say, we red, amber, green the portfolio again, and it has almost nothing to do with the sector that they're in, and very little to do with where they are in the capital raising cycle. It has everything to do with the founders, like the type of people who are running those organizations. And so that's been just a fundamental learning and insight and maybe validation of a thesis around really looking at the human capital, really looking at the people and their extraordinary resilience and kind of ability to overcome any obstacle in the way and actually see great challenges as opportunity. So that's been an amazing insight from this year.
Kind of being more specific, like what's happened at Kindred? I mean, how have you spread across more into different geographies? Like what's your own experience?
Yeah, so we have is the short answer. I think, we tend to think that hubs are still relevant. So it's not that there's this total flattening. I think it's relevant because we don't invest in very large teams that are remote and spread out all over the world. We invest in a small handful, maybe 1 to 3 founders or co-founders at the time at which we make an investment. And where those founders, base themselves when they first start out, we tend to find that it has these 3 different components. There's basically a hub is made up of a place with great talent. It's made up of a place which has access to capital. And then the third thing, which I think is maybe the most important thing that people talk about the least, is a belief system. It's like some place where you can be kind of crazy enough and have enough irrational hubris to go out and think you can change the way the world works in your respective domain. And that still is, if I look across Europe, London is still an extraordinary hub for that type of belief system in Europe. We're seeing those hubs in Berlin and Paris and in the Nordics, et cetera. But I wouldn't say it's flattening to the point of, every city in Europe. But we are spending more time outside of London, where we spent the most time, I'd say, as a part of Fund One. We're kind of spreading that, I'd say, across maybe 5 or 6 different hubs, as opposed to just 1 or 2.
Cool. More hubs is definitely a good thing. Andy, how about you? Like, which are you hanging out, and how much has that changed over the past 9 months?
Sure. So it's been great. I think when the lockdown first started and the world was on pause, we did see a slowdown in activity from the investment side of things, and we saw startups scenario plan a lot to just prepare for different 2020 and 2021 going forward. But what we have seen is an increase in the amount of investment, of course, at angel level, and we've seen it from across the board, even at fund level as well, with commitments from LPs. Even at our fund, we've seen commitments from LPs in Africa, America, South America, and different places in Europe, and startups have felt the impact of this as well. They're coming in with smaller tickets. I'm seeing commitments much faster now. And a lot of companies who may not have been able to raise prior to this lockdown and prior to this current world we're in. And it just shows that actually, when there was a pause and now we're seeing an increase in activity, it's not just the entrepreneurs who are becoming new business owners and the influencers on the internet. We're seeing actual people become angel investors now and start putting their money to work. And those who were putting their money to work previously are looking for new opportunities as well globally.
Very cool. I mean, what's your take, Rob? How are you seeing it?
Yeah, I think, one thing happening in Europe is, and I think it's something great happening, is there's a strong shift from consumer internet to more B2B models. And why is this so interesting? I think if you look at the true DNA of our European industry landscape, it's all those industrial world market leaders, right? A lot of those companies are in B2B. And maybe touching down a little bit on the German cluster, it's an interesting development, because the last 15 years have been a lot of consumer internet in Germany based out of Berlin. But this was pretty much a strong bias, with Rocket Internet and 2 business schools that brought up great students, starting consumer companies, some of them copycats, some of them really true innovations. But if you look at the strength of our kind of university ecosystem, it's technology students, right? So, and what we see now is really a wave of very strong B2B technology founders that build great companies out of Europe, where I think they can become true market leaders globally out of Europe. Take Celonis out of Munich, take Oculus out of Ingolstadt, Personio. And those students are now, those founders are going back to universities to inspire the next generation of students. The interesting thing is it's highly decentralized, right? You don't go to Berlin to find those people. You find an Instana, that just exited for 500 million in Solingen, a city no one heard about before. You find an Oculus in Ingolstadt. You find a staff base in Chemnitz. And I think for ourselves, we are really trying to focus on those clusters, trying to find the next generation of B2B founders. And I think this is also true across Europe, with a lot of, cities that bring up those kind of strong founders.
But besides Germany, do you feel that you can see the same thing in France, in Italy, in Spain as well?
Yes and no. I mean, Germany is incredibly decentralized, which is also due to the university ecosystem. We don't have an elite university ecosystem. We have a mass university ecosystem. I think with the UK and France, of course, London and Paris are such dominant clusters that a lot of activity is still happening there. But if you look at London, I think Cambridge, Oxford are incredible, strong technology universities, but you need this more like business talent, maybe from London, like programs like Entrepreneurs First to bring those companies up to speed. But I think it's those developments that are interesting. And I think for the other countries, if you look at Switzerland with Zurich and all the others, I think it becomes more decentralized.
Okay. Let's pass on to Hero. I mean, what's if you look at it from an Atomico point of view, like what about shift in the investment stages? Like, what are you seeing in terms of, like, is there more? Are people dipping more into earlier stages? and what's a late stage world looking like? I mean, there are so many mega rounds being done. Doesn't seem to matter what matters that we're going through a pandemic.
Yeah, I think it couples well with the last question you asked, Tavid. So I'm going to comment a little bit on that and then drive to answer that part of the question that you posed. I think one of the things that, who would have thought that I would go to Würzburg to find a company? I mean, and you'll see why I point this out. But I think, when Nicholas started Atomico, and you would remember then, because Tavid, you are also, part of the fabric that is the repeat entrepreneur. We said that great entrepreneurs, great companies can come from anywhere. We didn't make this up yesterday, right? Like, this is when Nicholas founded the firm after coming off of Skype, where I think you also probably felt this, but on a global scale, you knew that entrepreneurship was not exclusive to one area. It was just that the technology that was available was not maybe as as reachable as it is today. So that's why you find companies, I think, as per Robert's point, coming from all kinds of places. And then the other thing that I think has been really fantastic are people like you and others like Nicholas, and there's many more, who are coming back into the ecosystem to either facilitate the birth of more companies or helping others. And I think is really why, Europe especially is heading toward a very special place. And you've seen the track record follow this mantra. And I think that is super, super cool. What I think is also driving in the stage moment is just, we've lived in a universe pretty much since 2008 of, money printing. There's a lot of capital as a commodity in the market, and growth, as we've seen it this year, in this pandemic year, where I think, the world stood still for a minute, almost. We thought it would freeze over for the year, but I think, there was quite a lot of growth that came from tech. And as Layla had said, the acceleration has happened, despite a lot of the hardships that I think we should also think about and pause to try to support if you have been a beneficiary of some of these tailwinds. So as capital has grown, I think the stages have, the competitive nature, I think, that has become apparent in Europe because there's so much success, is becoming the lines, at least, like, we say going upstream, but I'm sure that you find, Layla, especially, that, there are a lot more people all of a sudden in seed, or even Andy in angel investing. So I think the thing is, like, you have these institutions that, are going earlier and earlier. I think we at Atomico haven't taken that stance. I think we rely on, people like Andy, who are not only, affecting the angel universe, but also other things in D&I, and with friends like Layla and Rob, who are, focused on an earlier stage of seed and Series A, even, maybe for Robert. But I think we rely on our ecosystem of partners to really help us. And so we've focused on, our Series A motion, which I think is our core. And secondly, there's a part that we get to do, which is the B's and C's in Europe and abroad. So I think that is where we sit in. But to your question, I think it is, yes, becoming a lot more blurred and complicated.
Make one point, Tavid, just on you mentioned mega rounds, and obviously that question was directed to Hero, as it should be, representing the stages on this panel that's most relevant to mega round. But I've actually seen it kind of even dip down with just the weight of the capital stack, to Hero's point. It's just kind of sagging into seed and pre-seed, and those round sizes are becoming really big. And I'm not sure actually how helpful that is. I think capital can be accelerative and kind of capital as weaponry at certain stages. But one of my partners likes to say that he's seen more companies die of indigestion than starvation. And I think that may actually be true at the very early stages, where you have to do something very specific to prove kind of a wedge, a focus, a product market fit, and then accelerate. So some of the worry is that because there is so much trapped capital, it's more kind of the VCs trying to shove as much capital as they can into companies or buy options into the later rounds than say, what does Tavit or what does Rob really need to achieve with this seed round, this angel round, and let's kind of make it fit for purpose for what they need.
Yeah, I mean, Layla, totally, because I think you see the amplification of that is probably across the board, but I'm sure in seed you see like a turbo of that, and then Tavit, to your point of mega rounds, I think we saw this year probably a bifurcation at the latter part of a company's journey, where a lot of capital, and great for Europe, by the way, has gone into some of these, decacorns and unicorns, if I can use those words still.
But what more does it mean? Does it mean the stuff is happening just faster, or is stuff happening at higher prices, or are just more people squeezing into the rounds, and actually the entrepreneurs are just having many more annoying investors sitting on their back and not really being helpful?
I think, first of all, it's great for the European ecosystem that we have those US funds focusing now on Europe, and that everyone is putting this attention on it. So it's good for founders. I think the tricky part is it has become incredibly competitive for Series A funds to win deals. And that's why they're starting to go in more early. And then you have the situation for a founder at the seed stage. It's very difficult, because if you have one of the big funds putting in like a small ticket in a seed round, which is not like the ownership focus of the fund, then you pretty much end up as a lottery ticket of this fund as a founder, because the fund just buys an option to lead a Series A round if things go right. If things don't go that incredibly well, which also happens a lot with seed stage companies, then founders have a huge signaling risk. If this fund doesn't lead the A round, that all the others say it can't be that great. At the same time, it's also that those funds don't spend that much time anymore with those companies. And I think what's happening right now, this mixing up of larger funds going in more early, I think it's something not very sustainable, because my interpretation of this is, if you're a strong Series A fund, you will win deals at Series A. If you have to preempt rounds too early in the seed stage, you don't have a good enough value proposition to founders in the Series A to win deals. And that's why I think what Atomico is doing is great, to say, we team up with those who do good seed deals and really support, those founders early on. But then we speak to them in the Series A, and we're not trying to dilute our strategy, doing like little lottery ticket checks in like 20 companies there, right?
But I would argue, sorry here, I would argue that you're doing the same thing. You're a wolf in sheepskin, you're employing angels to do this, so you can say we had nothing to do with it. But but does this signaling thing even matter anymore? Given that everyone is doing it, is it still relevant? Like 12 years ago when we got started, it was a huge thing. But now, given how much capital there is signaling important anymore?
But I think, Tavit, the thing that I would say is, to Robert and Layla's credit, and Andy as well, I think there's a lot of energy and effort that you have to put in helping a company at these particular points in time, of whether it's product market fit or kind of the team element of growth, and the commitment that one when I spend time with all the folks on this on this call, it's just that it's not something you can kind of half do. And so, yeah, you're right that maybe there's enough capital where the signaling isn't maybe as big of an issue. I still do think it is something that I always read into, but I think it's the effort and the energy. And so therefore, maybe Andy, to talk about, I think there's also the authenticity that each firm starts to kind of represent, and what is their superpower, what is their nature. I think the great entrepreneurs look for that, and they really try to find what is the meaning of your existence, because like you said, you have 50 investors who are calling you who you can't really tell the difference, and it really will lend itself to those of us who are on this side to commit to being authentic, building our reputation over time, and people to look at it. And Andy, you learn a lot, maybe more than just that, right? I'd love to get your
would love Andy's view on this, and then I think we need to start wrapping up after that.
100%. So I get calls all the time. these angels want to be on the deal. Can you tell me about these angels? And I'm like, tell you about the angels. I was like, so, well, they're helpful people, they're good people. They've helped these companies progress at X point. And the founders are now taking notes and debating with themselves. They went from zero capital to indigestion almost, right? And that's it. I think at the early stage, the founders now have options, right? They have so many options in the market. And I do agree with Layla. I think there is too much capital going in too early sometimes. I like to see companies raise their EIS rounds as well. But not so and a good example would be a company called me last week and said, hey, we're going to close 180. I was like, great. I helped them with the term sheet. They called back on Tuesday and said, oh, we just got another term sheet from a fund. They want to put in 750. And I was like, what do you need 750 for? And like, well, we haven't got a plan for it, but they think that we should take more money because they want to get involved. And I was like, but you haven't got a plan for it. You don't know how to spend 180. How are you going to spend 750 or a million, right? And I think that's happening more and more often. So I think there has to be a cautious tipping point where it isn't healthy for companies, and we have to all support companies, even if the funds want to get in earlier, we just have to be responsible and just help them understand what's best for their business today. And that's all about responsibility.
Fantastic. I think with this, we are probably out of time. Would love to talk about many more things, but I will hand it back to Tom, and thanks to all the participants.
Welcome back, and thank you so much, Tarvit, for leading that fascinating conversation. And now we move on to our last panel discussion of the day. We have Robert Viz and Johnny Bufarhat of the European Unicorns MessageBird and Hopin in conversation with Seedcamp founding partner Reshma Sahoni about raising fast and slow. Reshma, the floor is yours.
Fantastic. And I'm thrilled that we're closing this off. Excited about this. Just a couple of seconds on my intro. So yeah, Reshma Sahoni, founder of Seedcamp. We have been very fortunate to, I think, as I've been looking at the presentation today, to have been first check backers of companies like TransferWise, Revolut, UiPath, and more recently with Hopin as well. So very privileged to have been on this journey for nearly 15 years here in Europe. But I'm quickly going to turn over to these two guys because I think it's such a great story to end this 2 hours on. You both have different stories, and yet they're optimistic. And I think there's no other sort of poster faces for kind of grit and taking what's been a tough year and making it just an explosive opportunity. So with that, I'm going to go to Robert first. Maybe just a minute or even less on an introduction on you and MessageBird.
Sure. Hey, this is, by the way, pretty cool. Just the whole fact of such a big conference and doing it remote. Yeah, so I'm Robert. I'm the founder of MessageBird. For folks who don't know, what we do is we're an API platform for anything communications. So whether that's sending a text message or making a phone call, and we essentially provide the entire backend infrastructure to enable that. So talk on WhatsApp, talk online, Instagram, and then we build a bunch of tooling around that to make lives of our customers a lot easier. But the big North Star is we want to live in a world where we can text with a business. And that's where we wake up every morning and we think about how that makes life a lot easier and less time waiting on hold. Give back some time to friends and family. So yeah, that's what we wake up every morning to do.
Super. And then Johnny, we're on Hopin. you're the founder of Hopin. So maybe no major marketing needed there, but a couple of seconds and on you and the company.
Yeah, so I'm Johnny, founder of Hopin. Really love to be on the platform when it's in use, and you know we've expanded. We've been based in we've been a completely remote company, and we've expanded quite significantly over the last year. It's been a really great journey, but obviously we're looking forward to 2021.
Awesome. And you know, back in the back room there, you guys were kind of doing a deal together. So I'm pretty excited that we're at a point in Europe where you've got two unicorns, you know, sitting there in the back room, kind of getting deals done. So that's very exciting. So we're going to unpick your journeys a little bit because they are quite different. Robert, I'm going to start with you again. You know, and I want to understand a little bit sort of how thoughtful your sort of 6-year journey to building a 100 million revenue business and not taking external or correct me, but external money to that point, and then raising and you know, what was that journey like, and sort of what were some of your kind of best moments and the more challenging moments?
Yeah, sorry, I was going to say 10 years, but you're right, 6 years until we raised funding. Been 10 years now. No, so, you know, look, you know, first of all, I mean, we obviously came from a very fortunate position. I mean, we launched the company early 2011. I was working on a previous startup at the time, and it just worked from day one. You know, it's one of the things I've learned as a founder is, you know, when people ask you 5-10 years later, like, how did you start your business? There's something magical about like people that have built a big business, or where they just say it sort of just worked and it happened. And obviously there's a ton of work that went into it. But I mentioned the fortunate part because we were able to bootstrap for the first 6 years. We were profitable from day one. We had zero outside capital. Also ourselves, we put almost nothing in it except for our times. We were able to pay salaries in like month 2 or 3. There were very little salaries, but there was still money coming out. So that was, you know, that's an interesting journey as a founder. But you obviously need a little bit of luck to get there. I think what it's enabled us to do though is, you know, really move around the profitability line as a company. So either though we raised capital in 2016 and we think it's a massive opportunity and we want to capture it as quickly as possible, and we're making investments to do it. You know, we were a company that were profitable from day one. So this isn't like an endless promise. It's something that we can, you know, take a couple dials and turn it back, and then we'd be profitable again. So yeah, I think my main learning is you want to have optionality as a company, and whether your optionality is having a good balance sheet so you can execute on your vision from day one, or whether it's optionality because you're profitable and you're not dependent on anybody. But I think for me, optionality is something as a founder you should always focus on, because you never know where the world turns. So you better have some options if the world goes sideways one day or another.
Yeah, no, I think that's a great point. And I think obviously you've the privilege of getting people to pay for what what you're building and selling. So I think you are empowered to do that. And kind of, we'll dig into Johnny's story then in a second, but just the last bit on that part of it is, has raising changed you guys then? Has it sort of, do you do things differently, maybe take more risks? Are you using that capital to kind of buy versus buy companies versus build? I mean, how's raising that sort of changed for you, if at all?
I mean, nothing in the core of the company changed. So to me, the core is things like our focus on our customers, and that we make sure that they're happy every single day, and that if we make a mistake, we own it and we fix it and we move on. Or the core of our company is that we the unit economics need to make sense, and this means that we would never launch a product where the unit economics are negative. Not that there are companies that have worked really well for Uber, obviously, but that probably wouldn't resonate with us. So I don't think the core of our company changed when we raised capital. It's more the outside world. So our employees still pick up the garbage. I mean, this is we don't have paintings or golden doorknobs or anything, right? You raise capital because you want to do something useful, you want to have impact and build a big business, and things like M&A are a good strategy to do that. And there's other investments that we're making to grow, but I would stand pretty hard for our entire team that I think fundamentally everybody still goes to work the same day in their t-shirts and, tries to have a good time building something cool.
Yeah.
And whether you raise 5, 10, 50, 500 million, I don't think that changed. I think it gets really scary if the opposite happens, by the way.
Very good point. And then so flipping over sort of to Johnny, your history, if we can call it that, is I mean it's a year, right? Basically, I think the report just talked about sort of you've just taken beat Skype on fastest from kind of starting out of the gates to unicorn in 17 months. I mean, talk to us about that, because obviously, like with MessageBird's journey, Robert's had a bunch of time to set culture and processes and even product build. I mean, I think particularly that was what blew us away, is just you and your ability to build amazing product. But how do you do that when you're growing so incredibly fast with, again, people willing to pay you for things, right? And so your customer base is growing, your team is growing. Talk about product build and culture probably in that very fast.
Well, I can touch on a few things there, Reshma. And the first would be it's companies like Robert, like MessageBird, that allow companies like ours to build as fast as we do today. We don't have to go to the core layers of what we're building in order to build a great product. Behind the chat APIs that Hopin uses, it's not, we didn't build it from scratch. Later on we may, but the point is that it allows us to build very, very quickly. And again, it comes down to platforms like Robert's that have allowed us to do that. And similar sense from a company building perspective, we're a remote company. So doing this, I think I've said it, it's preached this, like it would really difficult to have done Hopin or launched or moved Hopin this fast, and actually, because our customers didn't care how, like when there was this much demand during coronavirus, our customers didn't care that we were 8 people, that we were 24 people, that we were having trouble, getting enough people to do customer support to make sure their venture success. All they care about is the end result. And so for us, I think if we were in a physical world, we would have had trouble here, because if we were hiring all in one office, London has a 3 months notice period in most cases. We wouldn't have been able to bring those people in during the time. So being remote allowed us to not think about where are we going to put an office, how are we going to make sure people are sitting next to each other in the relevant teams and playing, musical chairs with the tables, and like all these little intricacies that you get in the physical world just move away online. And so it was adding someone to Slack, adding them to GitHub, setting up a Notion doc. Like it was really that simple, and then asking for referrals. And we just got better and better as we went along, based on the people that we've hired. And so remote, and so I would say the two big things that'll, I would say 10 years ago, this 100% wouldn't have been possible. 5 years ago, it would have been a little difficult. And today, I think it's a lot more possible. And actually, I don't think Hopin's going to be the only ones moving this sort of pace. I think, again, it's companies like MessageBird that offer these APIs that allow companies to build their products much quicker. Even AWS is another good example of how much their services just moved up. And on the remote side, it allows you to do things that you weren't able to do before. Hire the best talent wherever they are. The products, in order to connect people, even online, like remotely, are just so powerful. So yeah, that's my perspective on it. I think that really there's going to be more and more of these kind of fast moving companies in the future, and definitely.
Yeah, no, and I couldn't agree with you more, and both really interesting points for our audience, who I'm sure fall into different categories and kind of in their own journeys. So I'm going to push forward a little bit in that to kind of more today of 2020, and sort of the massive rounds you guys have both raised. To take your point, then, when everything's moving fast, people are able to build fast. And then you have platforms like MessageBird, and you guys is Hopin becoming a platform as well. I mean, talk to me about that fundraising of, a lot of the big part of the report also is US money flooding in, right? And I think, Robert, you talked about sort of how that's going to really change European VC for the better. I mean, I think, always competition does that, which is great. And we're feeling the competition at our end. It pushes us to be better also. So just, talk about those experiences. This time, maybe Johnny, start with you. Is like, talk about those experiences. I know some crazy things happened to you during all of that. maybe talk a little bit about U.S. money and, why did you sort of take on U.S. investors and kind of how come you raised all that money? Because you guys are pretty lean, mean machine. So.
Yeah, it's a great few questions. I mean, because there's a few in there. The first one I'll start with is the first spot I'll start with is what I think why I took U.S. money rather than European money in the last round, the last two rounds. So for me, and you hear this a lot. I mean, that was my initial thinking, was when I would get advice, hey, take local money when you're a local business, if you can, if they're meeting the right valuations and the terms make sense. People that are really close to you, that can hustle, that can work hard. I was based out of Seed Camp's office. It was like, didn't have to pay for a co-working space, and it was great to connect with all the Seed Camp folk when I was in London. And so that was of value. But San Francisco, I mean, the one benefit that the VCs have over there is there's a lot more companies to gain experience from. The connections. I mean, I took Excel in our second round, and they were able to connect me with great people from all over. And it was and then when I connected with some of the folks in the US as well, so IVP in the most recent round, there was a Rolodex that was very large. There was, they had seen a lot of experiences. And so it made a lot of sense that as the rounds got bigger and bigger, we'd work with US companies. But I don't think actually European VCs are shying away anymore from the large valuations. I don't know if everyone would agree, but I'm seeing that it seems like they're starting to kind of level out each other. And also, I don't know if it makes a difference. I think nowadays there's enough European strong companies and founders that a lot of these European VCs or UK VCs will have enough in their Rolodex to make a founder feel like they have connections to the industry as they're scaling. As example of MessageBird and Robert, those are the sort of people that founders are kind of want to be speaking with as they're scaling, and maybe want to have a connection to as they go along. And I think European VCs will be able to offer that just as much as the US ones, especially over the next few years. And I think your second question is why we took so much money, even though we're profitable. Well, it's to scale fast. Hopin plans, we plan on doing an acquisition very, very soon. And the good thing about the world today is that you can move a lot faster. And so why would we move slower in anything? And being more capitalized allows us to take up more opportunities and more optionality.
Very cool. Robert, for you, and I think maybe just because of that quote I read, did you find differences during the last couple of rounds, kind of raising that money between? I mean, you have both, again, European and US VC, but just chat about that.
Yeah, I was trying to think if I agree or disagree. Look, I think. Let me say differently. I think for us, when we made the decision to raise, we really wanted to raise from a U.S. firm, and for the reasons that were just mentioned. The experience, the Rolodex, just the having done it before. I think any European founder that you talk to will probably talk about talent, and then we'll talk about the fact that the biggest talent gap we have is just folks having done it before, versus having to reinvent the wheel every single time. And I think that's a leverage that Silicon Valley brings that is very hard to scale. And I think that's similar with investors. So we took U.S. money from Excel. And then we wanted a European investor actually for the same reason that was also just mentioned, which is like boots on the ground, close. So we chose Atomico, founder led. It was very, very that. I do have a little bit more of a contrarian view on the overall ecosystem, which is I, as a founder who bootstrapped and who was obviously also able to retain, I think, a good part of their equity, and I can sort of assume that my dear colleague is probably even better off than I am at this point, but. I do think that things like that are important, and I think the biggest difference, capital is a commodity today, right? Our interest rates are so low. There's more and more allocation from like traditional capital into venture, because where else are you going to get returns? So I don't think that's a trend that's going to end. I would say that the terms are pretty important, right? That's the thing that people don't talk about. They only talk about the large valuation, and they're like super happy. But like, what are you have 1x lek pref or 3x? It's quite a big difference, actually. And those things people don't talk about when you see the TechCrunch article article on the large valuation. So in my experience, the biggest difference that I see around me is like, one, European funds taking way too much equity in a seed or a Series A, which I'm just fundamental against. And I know some of the more professional folks here don't do that, but it is something that I still see a lot around me, especially in the Netherlands. I see it. I've seen it in the UK. I've seen it in Germany. So I think that's one side. And second, I think it's speed. Like, the Americans, for what it's worth, they make a decision quickly, right? Like they think about it, they meet you, they have whole teams work. I mean, I did my I was going to say all hands, but all GP meeting on Sundays. There were literally funds that were like, no, if you can't make Mondays, my Monday's booked. I'll do a Sunday, I'll do a Saturday. You let me know, get the group together. I know we're talking about working from anywhere, but that's definitely a large pre of this situation. Like I didn't have to go down Sand Hill Road and, hop and pretend I didn't just visit Sequoia when I visited. So like, I got to just like hop on and off from a Zoom meeting and that was it. So I think that to me, the biggest difference is, I think, access to network, access to having done it before, and then the terms that you can raise on, and thirdly, speed. Make a decision quickly, Europeans. Stop even us. Like, if I did a matrix on like speed of responses, I will tell you all the top 5-10 VCs of Silicon Valley that we all know all reacted on every single email within 20-30 minutes. Let it be an hour, right? Europeans sometimes wait 2-3 days. Like we'd raise the money by the time somebody responded to our first meeting. I was like, what's going on here? Sorry, long answer.
Love it. Yeah, Robert, I'm going to cut you there for a last question because I have it in my ear. We're running out of time, but that's awesome. And look, I think that you both clearly I hearing a lot about speed, especially I think in the era we live in. But I think my takeaway was both Europe and US best VCs and start local with seed count. That's kind of what I got out of it. Just on last kind of question to get into is the future. The future we heard it all today, the last couple hours. It will be mixed. The future will be hybrid. I think particularly you guys are so interesting to have here. You're both in the comms infrastructure space. I know MessageBird, Robert, you're going more and more omni-channel. Hopin, thinks a lot, again, was built with thinking about a hybrid world and finally was pushed into this pandemic world. How are you guys preparing with your companies? Because you're better placed than probably anyone to take on this hybrid world. What should the audience of companies be thinking about in terms of kind of options, challenges to tackle, talent? I know there's a lot, and we have I think a minute. But so Robert, maybe a quick few thoughts, and then Johnny to end as well.
Okay, I'll make it really quick. For what it's worth, I was on the complete other side. You asked me 9 months ago, people working from home, I would have said no. And we did it for very positive reasons. We liked the culture, we liked interacting with people, et cetera. But like we said, no. I turned 180 degrees, took the whole company remote permanently. I fundamentally changed my mind on this, that the whole idea of people having to sit in a train or bus to an hour to work every single day, I can't get over that. Like you think about the environmental impact, you think about all other types of stuff. And look, I can talk about all the business reasons, right? Like better talent, I can recruit from anywhere. Like, there's all sorts of things that are good from the business side, but just think about we're also human beings on this planet Earth. Like you're taking people away from their friends and family because you're putting them on a bus every single day. How does that make sense? It just doesn't. And I think it opened up my eyes. We're never going back.
Wow, that's amazing. And I think, Sharmadine said it earlier. It's like, you got to be quicker. And it's amazing that you've had such a, as you said, a 180 on this and did it very fast, right? Johnny, obviously you believe in this and you started the company that way pretty much day one. But, kind of audience out there, what should they be adjusting to or thinking about as you built pretty much a hybrid business from the start?
Well, I would say, going back to I would say that the world is really changing. I would say, this is a lot of the playbooks that we had from 10 years ago or 5 years ago or 12 years ago. I think throw them right in the bin and go ahead and work for the new world. You be the innovator. If you go in and you build a CRM, again, that's built for this 17th CRM product that's been out there, or 17th million, I would say screw that. Come up with a better version, because at the moment the world is changing, and it's changing significantly. There's tons of opportunity in remote. There's tons of opportunity in hybrid, and so even the way you like, if I listened to people this year who said you couldn't scale a high quality company, who knows? You could be laughing at me in 2 years. But in terms of the talent we've hired, I think we've done a great job. And remote's allowed us to do it, and I don't think anyone would have been able to think that a company could go from 4 to 240 within a year, and maintain a quality bar. But remote allows you to do it. So I would say take up all the opportunity where there's white space, where people have not put their opinions, or even where product hasn't shown up, because there's going to be a lot of opportunities for product or opportunities for ideas to come.
That's awesome, awesome few messages to end this powerful session on. And I do remember Johnny used to come over, literally around the barrier, right? And be like, so I think I'm going to do X in revenue in 3 months, and I'm going to be this many people. And we're like, okay, we'd never seen it before. I'm just glad we weren't one of those people who are like, no way, not possible. So yeah, and you've executed. It's been incredible to watch. So, again, I think just to thank you both, incredibly inspiring. Also, just again, 2 very different stories. I love that, and a couple things, you sort of agree to disagree, right? Which again, for the audience, is many different paths. I think a few commonalities in terms of the messaging across you guys. North Star, kind of how you treat customers, how you treat people, how you think about adaptation and moving at that speed when you do want to be dominant out there at a global stage. So thank you again so much, and I'll turn it back over because I think we're ending on a pretty special guest.
Thanks a lot. Thanks for having me.
Thanks.
Welcome back, and first of all, thank you Reshma, Johnny and Robert. And finally, we're heading over to Paris, where Atomico founder and CEO Nicolas Zennström is sitting down with the President of France, Emmanuel Macron, at the Élysée Palace to talk about the state of tech here in Europe and why US giants should pay attention.
Nous sommes honorés d'être rejoints par le président de la République française, Emmanuel Macron, pour le lancement de notre rapport cette année. Sans plus attendre, j'ai le plaisir de passer la parole à Nicolas Zennström, CEO d'Atomico, au Palais de l'Élysée.
When I founded Atomico in 2006, I was determined to prove that great companies could come from anywhere, and that Europe in particular had most of the ingredients for a thriving technology ecosystem, top talent, some of the best universities, and an advanced telecommunications infrastructure. We had also proven that we could build global companies in other sectors, such as automotive, retail, fashion. A lot has changed since then, and today we have over 200 unicorns here in Europe. It is my pleasure to speak today with someone who is as passionate as I am about the strength and the potential of the European tech ecosystem. Mr. President, thank you for speaking with me today.
Thank you for being here.
As you know, today we're launching our annual report. And tell me, why are you so interested in speaking about the state of European tech?
Look, because I think this is one of the best ways to completely transform and reshape our world. I think our people, and especially young people, are strong believers in tech. And we are reshaping everything in our day-to-day life thanks to tech. And I think as as a president or as government, it's very important first to follow and try to understand these trends in order to accelerate and to be sure that we are part of the leaders. This is the very first point. Otherwise, you are just consumer of the tech of somebody else.
Yes.
Second, I think this is the best way to try to innovate in your environment, to maximize value created here, to build and to invent new jobs. And third, I think if you don't take care about tech, you have to live with the external negative consequences, and you have some. And this is why I do believe it's important as well to follow tech and to try to be part of it in order to make tech as a solution for a better world. Yes. And not just a solution for some people to earn more money, which is fine for me, and it is part of the game, but to be sure that this is the best possible contribution for, climate change, and in order to address our CO2 emission, for biodiversity, in order to deal with inequalities, in order precisely to have a more inclusive society, and so on.
Yeah, no, that's right. This year, 2020, must have been the most turbulent year than I can remember. And this is also, as you're pointing out, a time when we need solutions and the people who can innovate to do things in a different way. And how do you think that European tech entrepreneurs can contribute?
Look, first, they did contribute. They did contribute in such a year because they, thanks to, the big transformation in our companies and in our societies. When you look marketplaces, through teleworkings, and so on, we used a lot of tech innovations in our day-to-day life. We used a lot of US innovations and US solutions, but more and more European solutions as well.
Yes.
And for me now, what we have to do is in each sector, in each innovation, how to build the European solution and European sovereignty. Yeah. And for me, when I look at today's situation and the COVID-19 context, we have a lot of reorganization of our social life.
Yes.
A lot of our tech companies can be part of them. In order to consume, in order to work, in a more, I would say, flexible way.
Yeah.
But our people are keen on having more values, more sense, and they want social innovations, but including people living here. Yeah. Our local farmers, people living here and working and interacting with you through this innovation. Second, on the health, the healthcare sector. Thanks to innovation and the tech companies, we are at the very beginning of a new revolution for me, with a much more personalized and predictive medicine. Yeah. This is why I launched on Friday with a lot of French startups, but as well academic labs and universities, Paris Santé Campus, which will be in the very middle of the city, in Val-de-Grâce, so a super place in the middle of Paris, in order to have digital health innovations. And we will invest several billions. We will involve Dassault Systèmes, Sanofi, i.e. a software company, a large cap, and famous French large caps in the classical healthcare system, but a lot of startups, artificial intelligence players and so on. And this is the best way for me, and this is the best example, to have European entrepreneurs trying to completely change and disrupt the healthcare system. They will help to have predictive medicine, new treatments, to reorganize totally hospitals and medicine for people, and change the system for the best.
So healthcare is certainly one of the industries and the sectors we believe will completely be transformed by technology, and it's going to help us to have healthier lives.
Because you have medical devices, you have software, hardware, artificial intelligence, and classical healthcare innovations. Yeah. And on top of that, my strong belief is that we will have to add human sciences, philosophy, ethics, and so on. If you have all these competences plus math and so on around the table, you can indeed completely have breakthrough and put on the table new strong innovations, but you have to think at the very beginning how to make this innovation acceptable for people, for their own health system, how to make them acceptable for the system to have predictive and personalized medicine without having a sort of social bias. I mean, nobody wants a system where we will improve the way to treat you, to better understand perhaps the potential disease you have, but we don't want to have you a more expensive insurance system because we know that about yourself. So this is one of the examples of the very tricky approach. So healthcare for me is very, very key.
Right. And so we both share the common view that startups are key for economic growth in the future. And here in France, you have some of the best educational institutions. And so how do we encourage more people to become entrepreneurs? And given some of the big societal movements that we've seen this year, how can we encourage access for talented young people who are coming from underprivileged groups in society to also become entrepreneurs?
Look, this is a very, you're perfectly right, one of the critical issues, because you waste a lot of value and opportunities for people when they don't access to this part of our economy, i.e. entrepreneurship, and you kill a lot of value for yourself as a society. So what we try to do is, first, we invested a lot in poor neighborhood for education by having 12 people per class between the age of 4 to 7, and by increasing basically compulsory education from 3 to 16, plus between 16 and 18, now it's compulsory to have either education or training or apprenticeship system, because this is how to correct the social inequalities you have. So better education, more skills at school and so on. Something we have still to change, and for me it will be through new role models, is how to be sure that people are not blocked by themselves and the fact that they consider that they shouldn't, it's impossible, they will be part of it. And we have a lot of talents coming from immigration, poor neighborhoods and so on. It's super obvious for people they can access, for instance, to soccer. But it's less obvious they can access to entrepreneurship. And so on. And what we did is, with entrepreneurs and business angels, we launched new initiative. École 42, School 42, launched by Xavier Niel, for people to learn to code and so on. A large majority of these young people come from poor neighborhood without a lot of academic diploma. Station F, and a lot of this kind of ecosystem. Second, this is the official speech. If you take a place where you have two international, basically, airports, one of the greatest stadium, which will be part of our Olympic Games 2024, which is the youngest part of the country, north of Paris. You should say this is a French California. Since this is Saint-Denis, and seen as one of the poorest neighborhoods, because you have a lot of people basically coming from migration, and we made this mistake a few years ago to concentrate difficulties there. If you change the mindset, and de facto now, this is the place where we have one of the most level and the highest level of startup creations. So I think education and investment in education, official speech and how to change and convert the mindset, and third, new role models. And we have a lot of entrepreneurs coming from poor neighborhoods and so on. And entrepreneurship is one of the best way, basically, to progress in society. It's much more fair than large caps and so on, with a lot of codes and a meritocratic system, which is sometimes much more conformist. So this is, for me, the best way now to increase and maximize these opportunities for these young people. But this is why I have, first, to keep on having a lot of people creating startups in this country. Second, to have now scale-up strategy. Third, in order to do so, is to keep our talents and to attract new talents. When you have people coming from India, UK, Sweden, US, China, coming in Paris or other cities to join the startup ecosystems. It completely changed the mindset, and it's much more easy to have people coming from migration and poor neighborhood to be involved in your startup community. And so having talents is critical to have a scale-up of our startup ecosystem. So we created this, this French Tech Visa in order to facilitate and streamline all the administrative process and this bureaucracy in order to get access to everything. Second, we are still very attractive because we completely changed the way to look at France. You have free education, free healthcare system, and with a lot of other talents. So it's super attractive for talent. It's much, I have to say, much better than going to California because education for your people will never cost thousands of dollars a year. Nobody will ask for your paper or to pay first when you have a disease and you have to go to hospital. So this is the way to have attractiveness for Paris and this country. And third, we do believe in climate change and we are completely changing the country. So talents and financing. And we pushed very much during the past 2 years to have much more financing of the startup ecosystem. And one of the critical points on that is first, we changed the tax situation. We created a flat tax of 30%. We killed the wealth, the wealth tax for entrepreneurs. And we had a very strong increase of investment of our own entrepreneurs in the ecosystem. Second, we build on the business angels, entrepreneurs, and seed funds and private equity ecosystem. And we accelerate this point by making a financing innovation with new funds. And we gathered 6 billion coming from asset managers and large investors in order to redirect them on the startup ecosystem. And the result is here. We are #1 today in large tickets and in funding of the startup ecosystem for this year.
Yeah, so it's a record of 4 billion euros this year, which is, I think, twice it was used 3 years ago. And this is outpacing UK and Germany. So certainly it's happening. And I agree with you on the topic of role models. I think that role models are so important for entrepreneurs or people, talented people, to see someone like me, someone from my background can make this happen. And this was really much when we started Atomico was the vision that we had. So I'm so glad that you're aligned on that vision. It's so important. I want to touch on very, very quickly on something that I know that you're very vocal about the topic of digital sovereignty.
Yeah.
And you have been repeatedly said that we in Europe, we need to build our own solutions. We're not dependent on American or Chinese tech companies. And with that, what do you want to achieve and how do you think you can achieve that?
Look, by exactly such a strategy, we need European financing, European solutions, European talents, European regulation. And till now, when you look at the map, you had what we call here in Europe, the GAFA in the US, BATX in China, GDPR in Europe.
Yeah.
So we have regulation, fair point. This is a global reference.
Yes.
But we don't have the equivalent of these very, very large caps.
No, not yet.
And not yet. And we have some very smart and good ideas and successes with a few tech companies which became actual success, coming from all over the place and changed totally basically our landscape. What we need is, I do believe, to accelerate the European financing, having an actual European finance market. It's not yet the case. We have to accelerate the integration because the more you have your own financing, the more you have large tickets, the more you have your own M&As and your own investors with a potential exit to a European market. It's super. Euronext made a very great job, but this is still the very beginning. We have to accelerate financial European integration because it's key for this sector, which needs a lot of capital.
Yeah.
Second, we need an actual European digital market. Today, a lot of entrepreneurs have to deal with 27 regulations.
Yes.
And it's very hard because we speak about digital regulation, but sector by sector regulation, because it depends on sometimes your retail regulation. And domestic market for a US player is just US day one, and for a Chinese player is China day one. So this is why for me, the different directives arriving in the coming weeks, mid-December, for digital services and digital market are very critical. Yes. And they are part of a sovereign strategy, because it's how to have common rules to streamline and to lift barriers between the different countries. And third, we need our own regulation. And I think it's a win-win situation for our consumers and citizens. Why? Because it is how to guarantee to citizens and consumers, we can explain to you and report about privacy rules and so on. This is a European standard for democratic values. Otherwise, it's impossible. If I depend on the US cloud, I depend on US law and US regulation. I cannot guarantee you about the use of your data. If you want me to guarantee you about the use of your data, I need a European regulation. I have to guarantee I have, on the very critical points, European devices. Yes. And I have to guarantee I have a European cloud. Yeah. Because otherwise, your data will be somewhere in the cloud under another regulation. The only way to do so is actually to have this final European regulation. Yes. And the European, I would say, equipment accompanying this regulation. Yeah. So this is why, for me, financing, integration of our market and an actual single market, regulation for privacy and technological innovation, and having European data, European cloud, and European technologies to be sure we don't depend on the others. And this is how to maximize value creation in Europe as well.
Absolutely.
And this is where we will reconcile value creation for European economies and European workers, and respect of our values for citizens.
Yeah, no, I agree with that. And on the financing, there's a huge opportunity here also with the large pension funds that we have in Europe that to invest in tech, so that when we have these successful scale-ups, that the value creation is staying in Europe and doesn't go to foreign investors.
You're right. In fact, you have pension funds in some places. We have the insurance companies, and I think at a point of time we will have to revise and profoundly revisit insurance, private equity, and banking regulations in order to favor investment in tech and more than that, equity creating values. Yes. Because one of the consequences of the financial crisis 10 years ago was the fact that we over-regulated these players. Yes. Where, I mean, they didn't create the problem 10 years ago. It was super traders in the US and on the market financing which created the problem. And the result is that we over-regulated these big players. Yeah. And a lot of savings in Europe, and especially continental Europe, are indeed in pension funds, in insurance companies, in banking sector. Yes. We have to up our regulation to basically shift part of this savings to equity financing. Yes. It will be very good for tech companies. I agree. And lastly, you already touched on the climate. Yeah. And just a few days ago, you encouraged 75 tech executives, including me, to sign the call for Tech for Good, and outlining a transition to an ecological future. And we're now in COVID, but the big problem long term is really the climate crisis. Yes. And how can we activate tech companies to really fight this crisis? No, thank you very much. First of all, one word perhaps on this call, and thank you for having signed it. This call was for me very important, and is an intermediary result after 3 years of commitment, having a lot of CEOs. It's how to create a club of tech companies sharing not just innovation and tech, but as well values. Yes. And saying we have sometimes externalities in the market, and this is our common problem and our common concern. Yeah. So this call will be followed. just to have a series of rendezvous. 4th of March, we will create a scale-up meeting in Paris, 4th of March, in order precisely to have more impact and accelerate on this scale-up strategy. And in June, we will have a new Tech for Good meeting in 2021. But for me, the perspective is how tech companies can invest more themselves in green solutions and how they can invent themselves new solutions. I mean, thanks to tech innovations, we can reduce logistics, we can reduce carbon emissions, we can produce much more rapidly and much more, I mean, in the very end market, which is much better for the carbon footprint. Thanks to tech innovations, you can reduce mobility or optimize mobility in order to reduce CO2 emission. Thanks to tech innovations, you can reduce the carbon emission for households when they want to live on a daily basis. So for me, tech innovations should be driven by, I mean, this common goal, which is climate change. And if you put it as an objective of the system at the very beginning, you completely change the DNA of the system itself. And my conviction is that sometimes it's very hard for all companies and all systems and all governments to make a shift, because you have to deal with past interests and you have to help your people to make this things changing. You have to invest a lot to compensate and so on. When you speak about new companies, day one, you have to tailor the project in order to take into consideration the final objectives. We want a world with less CO2 emission, with more biodiversity, with more inclusiveness for everybody. How to take that as number one objectives of the system, as important as making profit for the shareholders. And if you put these values, plus I would say democratic values, because if you say all these things are the number one objectives of your system, you shape the model in such a way that everybody is driven by this perspective. And I had to say climate change, inclusiveness, and democratic values are three critical issues for tech companies, because the tech sector was created by a pure private initiatives and innovations, which is unique in our history, in our world. But sometimes it was purely driven by profit making. But young generations, and especially young entrepreneurs, they need to better understand and to make history, in effect, to make history. And they want to change this world, to make it a better place. And if we say making it a better place is being sure that everybody has a fair place in this world, in economy and society, whatever the color could be, whatever the gender could be, whatever your country could be. If you say making it a better place is a world with less CO2 emission and a more biodiversity answer. And if you say making it a better place is a world with freedom of speech, without hatred speech, without racism and so on, this is something you can do thanks to social networks, thanks to tech innovation. It's definitely feasible. But these issues were seen till now as sort of external issues and not a business issue. And sometimes our businesses, I would say, increase the difficulties in these different fields. And create more problem, having negative externalities to be dealt with by the government. No, I mean, and you're players, you're part of it, and we can make history together. And with tech leaders, we can make history on this field.
Mr. President, I so much share those values and that vision, and it is true, it's happening right in front of our eyes. The founders that we see on a daily basis have those same values and the same mission as you have, Mr. President. So I believe we'll get there, but we also need to all work together to make it happen. It's a lot of work in front of us, and I know that you have short of time, so I wanted to thank you so much for taking the time to speak with me today, and I hope to continue the conversation maybe in June at the Tech for Good. Thank you, Mr. President.
Nicholas, I was very happy. Thank you very much to you and your team for taking the time to come to Paris and speak about this so important issue.
Very important, yes.
And I think we have, if you can touch new future entrepreneurs, I always accept, because I always imagine that a young girl or a young boy can look at your video and be sure that he can be part of it and he can make history thanks to this kind of initiative.
Exactly.
So thank you.
Thank you for being so involved. Thank you.
Thank you.
Encore un grand merci au président de la République française, Emmanuel Macron, and thank you, Nicholas, for traveling to Paris for this fascinating conversation. It was well worth it. What a note to end on.
I think we can all agree that 2020 was tumultuous, too often tragic, and testing in a multitude of ways. But as Nicholas and President Macron just alluded to, it's in times like these when we need innovators more than ever. The European tech sector is, against all odds, ending the year with new hope and fresh momentum. So thank you to all of you for being part of this event. We look forward to seeing you again soon, hopefully in person at Slush in 2021, to see where tech takes us next. But for now, please head to www.stateofeuropeantech.com to read the report in full. And thank you once again to our speakers, our data partners, and of course, huge thanks to Slush, Orrick, and Silicon Valley Bank for their continued support. And I would also like to just take a moment to say a huge thank you to Sarah, to Eleanor, Arabella, Maxine, Bryce, and the rest of the Atomico team for their relentless energy, commitment, and passion to make this all happen.
Thank you, Tom, for starting this in 2015. We wish you all the best for the rest of the year, and we hope that you get some time to recharge. And we'll see you again in 2021.
much.